5 Keys to Mastering Liquidity to Trade Like a Pro by the Sigma Trader. Introduction. Liquidity is the invisible force that drives every price movement in the markets. While most retail traders focus on indicators and patterns, professional traders understand that mastering liquidity is the key to consistent profitability. Liquidity represents areas where large volumes of buy and sell orders cluster, creating opportunities for those who know how to identify and exploit them. This ebook reveals the 5 essential keys to mastering liquidity trading. Whether you trade Forex, indices, or any other market, understanding these concepts will transform the way you approach trading. You'll learn to think like institutional traders, spot high-probability setups, and execute trades with precision. The concepts covered here are based on smart money concepts, or SMC, and price action principles used by professional traders worldwide. By the end of this guide, you'll have a complete framework for identifying liquidity zones, executing high-probability trades, and managing risk effectively. Key 1. Understanding what liquidity really is, the foundation of market movement. Liquidity in trading refers to concentrations of pending orders at specific price levels. These orders create the fuel that institutions need to enter or exit large positions. Without sufficient liquidity, large players cannot execute their trades without causing significant slippage. Where liquidity pools form. Above previous swing highs, breakout buy orders and retail stop losses. Below previous swing lows, breakout sell orders and retail stop losses. At psychological round numbers, 100.00, 1.2000, 15,000, etc. Equal highs and equal lows, multiple touches at same level. Range boundaries in consolidation zones. Why institutional traders target liquidity? Institutional traders and market makers need liquidity to fill their massive orders. When they want to buy, they drive price down to sweep sell-side liquidity, stop losses below lows. When they want to sell, they push price up to sweep buy-side liquidity, stop losses above highs. This creates a predictable pattern. The market sweeps liquidity, triggers retail traders' stops, then reverses in the intended direction. Understanding this mechanic is the foundation of professional trading. The smart money cycle. 1. Accumulation. Large players build positions quietly. 2. Manipulation. Price sweeps liquidity to trigger retail stops. 3. Distribution. Institutions enter their positions using the liquidity. 4. Trend. Price moves in the intended direction with institutional backing. Once you recognize this cycle, you'll stop getting stopped out and start trading with the smart money instead of against them. Key 2. Identifying high-probability liquidity zones. Mapping liquidity on your charts. The first step to trading liquidity is identifying where it exists. Professional traders mark these zones before price reaches them, giving them a strategic advantage. Primary liquidity zones to mark. Recent swing highs and lows, last 20 to 50 candles, depending on time frame. Equal highs, 2 or more highs at nearly identical levels. Equal lows, 2 or more lows at nearly identical levels. Old highs and lows that have not been retested. Range boundaries in sideways markets. Daily, weekly, and monthly highs and lows. Multi-time frame liquidity analysis. Professional traders use multiple time frames to identify the most significant liquidity zones. A daily chart liquidity zone carries more weight than one on the 15-minute chart. Recommended time frame approach. Daily and 4-hour time frames are your strategic time frames. Use these to identify the major liquidity zones that institutional traders are targeting. Mark all significant swing highs and lows, equal highs and lows, and key psychological levels. These are the zones that will attract the most significant reactions. Spend 10 to 15 minutes at the start of each trading day marking these levels on your charts. 1-hour time frame is your tactical time frame. This is where you refine the liquidity zones identified on higher timeframes and track market structure development. As price approaches your marked daily or 4H liquidity zones, switch to the 1H chart to monitor how price is behaving. Look for signs of institutional accumulation or distribution as price nears these zones. The 1H timeframe helps you anticipate when a liquidity sweep is imminent. 15-minute timeframe is your execution timeframe. Once price reaches your liquidity zone and you see the sweep happening, drop to the 15-minute chart for precise entry timing. Wait for the sweep to complete, wick through the level and reversal. Then look for break of structure confirmation on this time frame before entering. The 15-minute chart gives you the exact entry point while keeping your stop loss tight. Characteristics of strong liquidity zones. Not all liquidity zones are equal. The strongest zones share these characteristics: multiple retests without breaking, 3+ touches; clear rejection wicks showing previous defense; confluence with support and resistance levels; located at psychological round numbers; aligned with higher time frame structure; and clear concentration of retail stop losses. The more confluence factors a liquidity zone has, the higher the probability of a significant reaction when price reaches it.
Key 3. The liquidity sweep pattern. Recognizing the sweep. A liquidity sweep is the moment institutions execute their plan. Price briefly breaks through a liquidity zone, triggers pending orders, then rapidly reverses. This creates a characteristic pattern on the chart. Anatomy of a liquidity sweep. 1. Price approaches a clear liquidity zone, swing high or low. 2. Price breaks through the level by 5 to 20 pips, varies by instrument. 3. A wick forms as stop losses are triggered. 4. Price immediately reverses back inside the range. 5. Strong momentum in the opposite direction follows. Buy-side versus sell-side liquidity sweeps. Understanding the direction of liquidity sweeps is crucial for positioning your trades correctly. Sell-side liquidity sweep, bullish setup. Price breaks below a swing low or equal lows. Retail traders' buy stops are triggered, stop losses. Smart money buys into this liquidity. Price reverses strongly upward. Result: opportunity to enter long positions. Buy-side liquidity sweep, bearish setup. Price breaks above a swing high or equal highs. Retail traders' sell stops are triggered, stop losses. Smart money sells into this liquidity. Price reverses strongly downward. Result: opportunity to enter short positions. Confirmation signals. Wait for these confirmations before entering after a liquidity sweep. Strong rejection candle, large wick, small body. Engulfing candle in the reversal direction. Break of structure on lower time frame, 15 min. Volume spike during the sweep. Immediate momentum away from the swept level. The more confirmation signals present, the higher the probability of success. Key 4. Entry, stop loss, and take profit strategy. Precision entry techniques. Entering at the right moment separates profitable traders from those who get stopped out. After identifying a liquidity sweep, use these entry methods. Entry method 1. Aggressive entry. Enter immediately after the sweep candle closes. Place entry at the close of the reversal candle. Suitable for experienced traders with strong read on market. Higher risk but captures more of the move. Entry method 2. Conservative entry. Wait for retest of the swept level. Enter on the pullback to the liquidity zone. Look for lower time frame, 15 min, confirmation. Lower risk but may miss some moves. Entry method 3. Order block entry. Identify the last bearish order block before buy-side sweep, or vice versa. Place limit order within the order block zone. Wait for price to fill your order. Most conservative approach with best risk-reward. Stop loss placement. Proper stop loss placement protects your capital while giving trades room to breathe. Stop loss rules. Place stop loss beyond the liquidity sweep wick, 5 to 10 pips buffer. Never risk more than 1 to 2% of account per trade. Account for spread and slippage in volatile conditions. Consider daily ATR for appropriate distance. On 4H time frame, typical stop loss is 20 to 40 pips depending on pair. EUR-USD and USD-CAD trades usually require 30 to 40 pips, while GBP-USD and indices like DAX might need 40 to 50 pips. You can risk 1 to 2% of your account on these trades, with 1% being conservative and 2% being more aggressive for high-confidence setups. 1-hour time frame trades require tighter stops of 15 to 30 pips. These are more active trades requiring closer monitoring. EUR-USD typically needs 15 to 25 pips, while GBP-USD might require 25 to 30 pips. Risk 1 to 2% per trade, but be more selective with your setups at this time frame due to increased noise and false sweeps.
Take profit strategy. Professional traders use multiple take-profit levels to maximize gains and lock in profits. 3-tier take-profit system. TP1, 25% of position, 1-to-1 risk-reward ratio. Quick profit reduces risk. TP2, 50% of position, 1-to-2 risk-reward ratio, main target. TP3, 25% of position, 1-to-4 risk-reward ratio, extended target to opposite liquidity. Target selection. Opposite liquidity zone, if swept lows, target highs. Previous day or week high or low. Major psychological levels. Supply or demand zones in the target direction. Recent unmitigated order blocks. Risk management framework. Professional liquidity traders follow strict risk management rules that protect their capital during losing streaks while maximizing profits during winning streaks. These parameters are non-negotiable if you want long-term success. Risk per trade. Never risk more than 1 to 2% of your total account balance on a single trade. If you have a $10,000 account, your maximum risk per trade should be $100 to $200. Most professional traders risk only 1% on standard setups and increase to 1.5 to 2% only on the highest conviction trades where multiple confluence factors align perfectly. This conservative approach ensures that even a string of 10 consecutive losses only draws down your account by 10 to 20%, from which you can easily recover. Minimum risk-reward ratio. Every trade you take should target at minimum a 1 to 2 risk-reward ratio. If you're risking 30 pips, you should be targeting at least 60 pips. This means you only need to win 35 to 40% of your trades to be profitable. For liquidity sweep setups with strong confluence, aim for 1 to 3 or 1 to 4 risk-reward ratios by targeting the opposite side liquidity pool. Many professional traders consistently achieve 1 to 4 ratios on clean liquidity sweeps. Maximum daily risk. Set a daily risk limit of 4 to 6% of your account and stop trading once you hit this limit. If you're risking 2% per trade, this means stopping after 2 to 3 losses in a single day. This prevents emotional revenge trading and protects you from blowing your account during adverse market conditions. Take the rest of the day off, review your trades, and come back fresh the next day. Maximum open trades. Limit yourself to 2 to 3 simultaneous open positions. More than this makes it difficult to manage your trades properly and increases correlation risk, multiple losing trades if markets turn against you. Focus on quality over quantity. 2 well-planned trades are better than 5 mediocre ones. Break-even move. This is one of the most powerful risk management tools. Once your trade moves into profit and reaches a 1-to-1 risk-reward ratio, your profit equals your initial risk, immediately move your stop loss to your entry price, break even. This locks in a risk-free trade. Now, even if price reverses and stops you out, you lose nothing. This technique allows you to hold trades for much larger targets, 1 to 4, 1 to 5, without stress, because you're risking 0 after the initial move in your favor. Key 5. Combining liquidity with market structure. The power of confluence. The highest probability trades occur when liquidity sweeps align with market structure breaks. This combination creates setups with 70 to 80% win rates in the hands of disciplined traders. Market structure basics. Uptrend, higher highs and higher lows. Downtrend, lower highs and lower lows. Break of structure, BOS. Break of previous high or low confirming trend. Change of character, CHOCH. First sign of potential trend reversal. The complete trading system. For bullish trades, buy setups. 1. Identify overall market structure, daily or 4H timeframe. 2. Confirm you're in an uptrend or looking for reversal from downtrend. 3. Mark sell-side liquidity below recent swing lows. 4. Wait for price to sweep the liquidity, break below and reverse. 5. Confirm with break of structure on 1H or 15M timeframe. 6. Enter on the break of structure or retest of swept level. 7. Place stop loss 5 to 10 pips below the sweep wick. 8. Target buy-side liquidity, previous highs for take profit. 9. Move to break even after 1-to-1 risk-reward achieved. 10. Scale out at TP1, TP2, and let TP3 run. Best trading sessions for liquidity.
Timing is everything in liquidity trading. The Forex and indices markets operate 24 hours, but liquidity sweeps are far more common and reliable during specific sessions when institutional volume peaks. London session 0700 to 1100 GMT is the first major volume spike of the day. European banks, hedge funds, and institutional traders begin executing their orders. This session accounts for approximately 35% of daily Forex volume. You'll see frequent liquidity sweeps during the London Open, especially in EUR pairs, GBP pairs, and European indices like DAX and GER40. The first hour, 0700 to 0800 GMT, is particularly volatile as London market makers sweep overnight liquidity pools. Focus on major EUR and GBP pairs during this session.
New York session, 13 to 17 GMT, provides maximum liquidity and the highest quality setups. This is when Wall Street opens and U.S. institutional money enters the markets. The overlap between London and New York, 13 to 16 GMT, is the most liquid period of the entire day, accounting for over 50% of daily volume. USD pairs are extremely active, and liquidity sweeps are clean and powerful. The first 2 hours, 13 to 15 GMT, around the New York Open are prime time for liquidity sweep setups. If you can only trade one session, make it this one. Asian session, 00 to 06 GMT, has significantly lower volume and is dominated by range-bound price action. Liquidity sweeps during Asian session are less reliable because there isn't sufficient institutional volume to drive strong directional moves after the sweep. Price tends to chop back and forth between the same levels. Unless you are specifically trading JPY pairs or Asian indices, it's better to avoid this session or reduce your position sizes significantly. Save your focus and capital for London and New York sessions. Session transition times are also important. The last hour of Asian session going into London Open, 06 to 08 GMT, and the last hour of London going into New York, 12 to 14 GMT, often see liquidity sweeps as one session's players close positions and the next session's players enter. Advanced tips for higher win rates. Trade in the direction of the higher time frame trend, daily or weekly. Wait for multiple confirmations before entering. Patience is key. Avoid trading during major news events, unpredictable volatility. Use pending orders at key levels to avoid emotional entries. Keep a trading journal to track your liquidity sweep setups. Review your trades weekly to identify patterns in winners and losers. Focus on 2 to 3 pairs maximum to become an expert in their behavior. Never revenge trade after a loss. Stick to your system. Common mistakes to avoid. Entering before the liquidity sweep completes, premature entry. Ignoring higher time frame market structure and trend. Using stop losses that are too tight, getting stopped out unnecessarily. Chasing price after missing the initial entry, FOMO trading. Over-leveraging because the setup looks perfect. Trading during low liquidity sessions, Asian session. Not taking partial profits at TP1 and TP2, holding too long. Failing to move stop loss to break even at 1-to-1. Conclusion. Mastering liquidity is the bridge between struggling retail traders and consistent professionals. By implementing these 5 keys, you're now equipped to understand the institutional mechanics behind price movement, identify high-probability liquidity zones before price reaches them, recognize and trade liquidity sweep patterns with precision, execute trades with proper entries, stops, and take profit levels, and combine liquidity concepts with market structure for maximum edge. Trading liquidity is not about predicting where price will go. It's about understanding where institutions need liquidity and positioning yourself to trade with them, not against them. Your action plan. Start by marking liquidity zones on your charts this week. Observe how price reacts when it reaches these zones. Paper trade liquidity sweeps for 2 to 3 weeks to build confidence. Begin live trading with small position sizes, 0.5% risk. Gradually increase position size as your consistency improves. Keep a detailed journal of every liquidity sweep trade. Review and refine your approach monthly. Remember, trading is a marathon, not a sprint. Master one concept at a time, practice discipline in your risk management, and trust the process. The market will always provide liquidity sweep opportunities. Your job is to be ready when they appear. Build systems, not goals. Stay locked in. Trade with discipline. The Sigma Trader.